The majority of analysts definitely still have a buy rating on this stock. I think looked at 28 buy ratings, only 2 sells. So this is a way to sort of hedge ahead of those earnings today coming out. And you know, they have reason to. After last quarter, Netflix had a big miss. Subscriber growth came in short, and that's one of the key metrics that we're looking at in Netflix earnings today. We're looking for earnings per share of 68 cents, revenue of $3.9 billion, but the company has said it expects 5 million new subscribers. Last quarter, it reported a slowdown in subscriber growth. So the question is if that was just a temporary blip or if it is the start of a bigger slowdown in subscribers.
It's a fantastic company. No one's denying that. What they've done to reinvent themselves and keep the model going is brilliant. But we're all worried about customer acquisition costs. We're worried about production costs. We're worried about the growth of those subs as well. But it's when the analysts had this stock in June when it was trading at $423. They had it worth the sky, and now it's come off $90. Now they're cutting the price. Mike, want to get involved?
Well, no,
my indignation, or do you want to calm me down?
Well, part of it is when everyone owns something, we're not just focused on the earnings, we're focused on what we pay for those earnings. So you know, you become a lot more sensitive to misses when so much is baked into the price.
And the shares are still up. You have to remember, nearly 70% so far this year. So this is still a bull run for Netflix despite the recent weakness, and that's something that a lot of analysts are pointing to. They think there's a lot of growth to come in the international segment particularly. That's an area that we're going to be watching in the earnings today.
Final point for me before Jeff comes in and calms me down, which he's done for the last 17 years. 80 times forward. Oh, come on, Elizabeth.
Pretty high valuation.
That's twice of what the NASDAQ was trading in 2000 when it went bust.
That's right. That's right.
I think if any analyst is selling this on a PEG ratio, don't pay any attention to it.
But it's different this time.
But you should be in a position where you could sell a stock based upon some degree of a DCF that looks credible. So you should always challenge the blue sky. And that's what I would suggest for anyone looking at tech stocks. Is 4 times sales the right level for Amazon, 107 times earnings? Give me a scenario where that valuation makes sense, and I'm happy to buy dips. But a lot of times when everyone owns something, the valuation is actually driving the buy ratings as opposed to the analyst arguing that the valuation makes sense.
Let's just use an analogy here. The problem is that the way we've thought about FANGs has been about, it's like mountain climbers all roped together. And they're scaling the ascent at the same time. And in effect, it's all part of the same story. But the reality is they're not the same. And yet the market has been prepared to go with the mountaineering analogy, because how is Netflix the same as a Facebook or a Google in terms of either its ability to disrupt going forward or to marshal incredible access to data to provide complementary and profitable services? We've seen the ability of these businesses that are real disruptors to find new avenues for growth here. And then we talk about Netflix, which is an iteration of a video delivery system, effectively, online. Now, in what way does that deserve the same multiple and premium that you would expect in a Google or a Facebook or elsewhere?
Yeah,
or have I got it all wrong?
Well, they're not all the same multiples and premiums. So in the end of the day, I would say they're all long-term winners, though. I think that's what the market is universally accepting. But I think everyone needs to take a step back and say, what's the blue sky and is that credible? You should be in a position where the DCF on the bull market scenario makes sense. And if you have to stretch, and that's what the analysts should be answering that question with. Every time they publish a note, they should be defending the valuation. It should never be relative. It should never be versus their price target. Right. It should be saying, this is possible, and this is why I think you want to keep owning this stock, and you should take advantage of the weakness in the stock every time to re-engage. Analysts too often don't do that because it's much more about momentum and not wanting to miss a trick.
Elizabeth, want to have the final word on this one?
Well, it's the first big tech earning we've seen, so people might, as you were saying, Jeff, be reading into this for those other stocks, but we'll have to see. They don't necessarily go hand in hand, but certainly a lot of attention paid to Netflix today.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.